How would the balance sheet be prepared from the inventory cards? So in the next assessment, we're moving to how to make the financial reports. So what we've been doing is let's look at a very simplified version of our accounting process. So we've got and that's where millions of transactions occur for every business. Well, not millions, but for a lot. And there is a source document for each one. We've done that. And then we said stage 2, we've got to record them. And we've been doing that in something called the general journal and some ledgers. And now what we need to move on to, what we're doing now at the moment is recording these in inventory cards. But in stage 3, we've got to prepare reports. We've got to do a balance sheet, an income statement, and a cash flow statement. And then stage 4, which we'll get to in Unit 4, is we need to then analyze these financial statements and make some decisions. So what we need to do is look at, well, how would we prepare the balance sheet for inventory based on what we know? Well, let's just go over what a balance sheet is. So we just write here, balance sheet, we're at the business name, balance sheet as at a certain date. And what it is it's the statement of financial position of a business, and it shows 3 things: the assets, and what they are present economic resources or benefits, controlled by the entity as a result of past events. And that goes on the left-hand side here. On the right-hand side, we put the liabilities, and we learn that the definition of those is that it's a present obligation to transfer an economic resource or benefit as a result of past events. But we also have on this side the owner's equity or capital. And what that is it's the owner's residual interest in the assets of the business after deducting all of its liabilities. So we call this side the asset side, and we call the other side the equity side. And what that's about is that equities isn't that owner's equity. No, we're saying equities is actually liabilities plus owner's equity. And that's because your assets for a business must always equal your liabilities plus your owner's equity. That was something we called the accounting equation. And then we just learned one new thing. We said we should make a classified balance sheet where we get our assets and our liabilities, and we break them into current and non-current. And we just said with assets, current assets are the ones reasonably expected to be converted to cash, sold, or consumed by a business within the next 12 months. Whereas non-current are the ones that we reasonably expect to be used by the business for more than the next 12 months. And current liabilities, they're the liabilities that are reasonably expected to be settled within the next 12 months, and non-current were the ones that are not required to be settled within the next 12 months. So we're talking about inventory, and what we also learned is that we'll just assume inventory will always be sold within the next 12 months, and that might not be true. In fact, it's probably definitely true for a lot of businesses. You might have some particular inventory that never sells, but the point is we just need a rule or an assumption. So we will always assume that inventory in the balance sheet will be a current asset. So we will put it here. So we can see here's a very sort of brief balance sheet, but it's a balance sheet, and inventory always goes there. We just always assume it will be sold within 12 months, even if that's not the case. We never want to see it as a non-current asset. And that's a real world thing too. So businesses in the real world report their inventory as a current asset. So now the question becomes, how do we know the correct amount to put under inventory in the balance sheet? Like, where does that amount come from? So we're over here in the balance sheet, we're kind of cutting a few steps there and saying, where do those numbers come from? Well, that'll actually come from the inventory ledger. So we've been doing ledgers for a while now. So we'll say to get the number for the balance sheet, we'll need to get it from the inventory ledger. But now the question kind of becomes, well, where does that number come from? So to get the number in the inventory ledger, we'll need to get the inventory cards. And just remember, there will be an inventory card for every different type of inventory a business has. So these could be all the different models of inventory that a business has. If we total all those up, that will equal what's in the inventory ledger. And then we just put that total in the balance sheet. And that's how we'll report inventory in the balance sheet. So let's say here we had all these inventory cards and they had separate balances like this, and we added them all up. That actually comes to 37,200. So our inventory ledger would have a balance of 37,200, and in the balance sheet we go right under current assets. Inventory has a balance of 37,200. So this one comes from here, and this one is just the total of all of these inventory cards. So I guess the next thing we just want to do in the next couple of videos is go, well, maybe it's not that easy. Maybe we need to be able to interpret the information in the inventory cards. And also maybe we actually have to recreate the inventory ledger from the inventory cards. So we'll look at these in separate videos next.